All right, well then, let's go ahead and jump into this discussion. As the semester goes on, we will see some things in both our discussion and in your lab work related to managerial or cost accounting. And in this discussion, we will talk a little bit about that. But our primary discussion, at least at this juncture, will be on financial accounting. And so one of the first things we'll talk about is the differences between financial and managerial or cost accounting, controlling. How are those things different? We'll talk about the organizational data related to financial accounting. Some of that we've already talked about, but we'll go into a little bit greater detail. We'll talk about the different kinds of master data involved in financial accounting and how those things are accounted for. But a lot of what we will do is talking about the actual basics of the accounting transactions and key processes in financial accounting, and emphasize, of course, that financial accounting is at the heart of not only SAP ERP, but any enterprise information system, because a lot of what you are doing is keeping track of transactions and keeping track of the financial dimensions of transactions is a key facet of the system functionality. Perhaps you are already starting to see in your lab work that things that you might have made a mistake on back in phase one can disrupt your work in phase three. When we're looking at things related to accounting, accounting has broad integration points throughout all of the processes. And so you did a lot of your financial accounting configuration back in phase one. So hopefully you did it correctly so that it doesn't come back to bite you in the future. And we'll see that as we go along here. So the first thing for us to talk about, I think, is what is the difference between financial accounting and managerial accounting? You had a question about this for homework. Some of you put together a good answer. Some of you put together a good answer that encompassed kind of one facet of the answer to this, but didn't really talk about a diversity of things. So let's spend just a little bit of time on this. Financial accounting is about tracking. Get my pen to work here. We're back to this fun situation again. Hang on. I love it when I can write with my finger, but I can't write with my pen. Doing the equivalent of unplugging it and plugging it back in to see if it works here. Okay, well, I guess I'm not going to be able to write on the screen here at least a moment, so let's kind of just talk through these and you'll just have to jot them down on your own. One of the key facets of financial accounting is keeping track of the financial accounting implications of our business processes and reporting those on standardized financial statements. So keeping track of the financial impact of different transactions in our organizations and then reporting them, there we go, on standardized financial statements. So I've already given you that one orally, so I'm not going to jot it down, but that's one notable thing about financial accounting. When we think about the statements that we typically associate with financial accounting, we have the balance sheet, we have the income statement, which you will more typically see referred to in the SAP interface as a P&L statement. for profit and loss, but those are synonymous terms. And then a statement of cash flows. Balance sheet, income statement or profit and loss statement, and statement of cash flows. So financial accounting captures transactional information as it has a financial impact for our organization, reports the impact of those things on the balance sheet, income statement, and or statement of cash flows. It has a governmental reporting dimension. Governmental reporting. We've talked about this before. We may have to file taxes with the IRS. We may be a publicly traded company and therefore have filings that we have to do with the SEC. There may be other legally mandated things for companies in our given industry. So financial accounting is very much focused on governmental reporting. The idea here is financial accounting is where we can go if we want to see the current financial situation of our company. So this is going to be presenting the current financial situation. And the really nice thing about a contemporary ERP system is we can know the current financial situation of our company, literally where we are right now. And some of the things that are coming out with the newest release of SAP ERP even enhance our ability to work with this, and I'll talk about that at some point later in the semester. So because this is governmentally reporting focused, and because these are documents that often must be disclosed publicly, the requirements here are often set, requirements defined in some cases by laws. In some cases it's not necessarily laws, but it's government policies. And then of course you have standards set by various financial accounting groups. In the US, we typically think in terms of GAAP, generally accepted accounting principles. Outside of the US, the dominant element there is IFRS, International Financial Reporting Standard, and a lot of American companies are even using IFRS, or they're using GAAP and IFRS in tandem, and we'll talk about that a little bit later in our discussion, although perhaps not today. So those are some of the key facets of financial accounting. Any questions about any of that?
Can you tell me what IFRS stands for again?
International Financial Reporting Standard. Mm-hmm. Other questions?
Could you also do the US GAAP?
The U.S. is United States. GAAP is generally accepted accounting. I don't know whether it's practices or principles, but principles, okay, principles. Generally accepted accounting principles. And as we observed before, because these are defined by laws and governmental policies, this is where you will see country-specific variations. So if we are a multinational company, this is something that represents a potential point of headache for us. As soon as you cross the border, you now are subject to the laws of more than one country. So that's financial accounting. Managerial accounting tends to have two focal elements. Focuses on costs or expenses, whichever term you prefer, and revenue. So we tend to really focus in on the cost dimension of our organization and our revenue. This is, as the name implies, designed to support management decisions. So you can think back to your experience with ERP SIM if you don't have any other experience in this domain. But with an ERP SIM, one of your key questions was pricing your products. Well, that's a very important issue for companies in the real world as well. How do you price your products? Well, clearly one of the elements of that is knowing what your costs are related to make and or sell an item, and having a true picture of what that is could be the difference between being profitable and not being profitable. I'm reminded of there was a store where I used to live in Florida that was an appliance store. And I remember the name of the store was Stone Super Service. And Mr. Stone was this really old guy who used to show up in all of their commercials and talk about his business. And, they were in business for decades. And all of a sudden, one day it was in the news that he died. And then 6 months later, the company declared bankruptcy. And it was discovered that pretty much they hadn't been profitable for a really, really, really long time, but nobody really understood the financial records to understand exactly what kind of dire situation they were in. Well, that's not the situation clearly that companies want to find themselves in. They want to know the cost factors associated with doing business. They want to understand revenue. What we're seeing playing out right now in the economy is a great example of this. If you've gone to purchase gas recently, you know that gas prices are on their way up. And in fact, I don't know that it's hit this area, but in other surrounding areas, there's actually a gas shortage where people can't get gas.
Is that because there's like a leak in the gas pipe?
Yeah, my understanding is there's a pipeline that has a leak in it, and they've had to stop using the pipeline until they can fix the leak. And then they'll be able to flow gas again.
He said that his family had to drive around to like 10 different gas stations just to find gas.
My brother and sister-in-law live near, they live near Western Carolina University, and there's not a gas station in their area that's selling gas right now. There's not a one. And in fact, Western Carolina has declared, I forget what they've called it, but like a state of emergency. And so their classes, unless students have to be in class, their classes aren't even meeting. They're expecting to do everything online because nobody can get gas to drive back and forth to campus. So, that's an example of you're planning, and you're planning on, okay, gas has been about this much a gallon, so we're making predictions for the future, we're setting prices, and then all of a sudden gas prices spike, and what does that mean in the context of our organization? So although the impact of the gas price spike will be felt in financial accounting, it's really the cost management dimension of managerial accounting that will really, really focus in on that and hopefully provide some guidance for us in decision making. This is internally focused. So to a certain degree, what you do in managerial accounting can be things that you have invented as a way of doing things internal to your organization. I have a good friend who I went to school with many years ago, and he left, after we graduated, I went into academia and he went into working for business, and he worked for a number of years for the Disney company. I've told some stories in other classes related to Disney that I've gotten from him. And he is now the vice president for analytics for, I think it's MSNBC or maybe it's NBC, I forget which. But I was looking at his LinkedIn profile the other day, and he actually has, I didn't even know you could do this, he has 5 patents related to different managerial accounting calculations that he has developed for things like valuing excess time of advertising and other things of that sort. Well, a company can do that. Managerial accounting is just for our own purposes, so we can employ whatever techniques we think will help us better plan and make decisions using, of course, what this is all revolving around is money and other statistics related to this. So this is internally focused, and it's very much based on company needs. So one of the things that you will see, and one of the reasons why we have not done a lot with managerial or cost accounting to this point in your lab work, is managerial accounting really is totally optional. We have to do financial accounting. because the IRS and the government is going to require that of us. But managerial accounting is just for our own purposes. So if we don't want to expend a lot of effort here, we don't have to do that. We don't really have to do any managerial accounting, although in most organizations of any size, you're going to see them doing this to one degree or another. So where we're going to mainly place our focus as we continue on here in this discussion is on financial accounting. And this diagram illustrates, although it doesn't provide much in the way of details, how just about everything we do in our organization relates to financial accounting. If we work our way around the wheel here, procurement is at the top. We buy stuff. Well, first of all, when we buy stuff, we're probably going to be expected to pay for it. So that's going to hit financial accounting. What we are buying, we have to evaluate in terms of, is it an asset, is it an expense, and record that appropriately in financial accounting. We'll talk more about that. Production. You're looking at taking things that have one value and by applying effort to it, turning it into other things that have different value associated with it. And in so doing, you're expending resources, manpower, perhaps other things. And so we're looking at not only material valuation in the context of production, but other expenses that may come into play. Fulfillment, one of the key elements in terms of financial accounting and fulfillment is the fact that we are taking something that we own and turning ownership of it over to another party. And so we have very interesting questions about things such as when does title pass and what are the arrangements for that will be captured and represented in financial accounting. We have something that might have been an asset for us that now is exiting our premises, and so we have to record all of the implications of that. Asset management, I think we talked about before. One of the key things we do with assets in terms of financial accounting is depreciation. And so that will be something we will talk about. You'll notice management accounting listed here, and that's because management accounting will get its data from financial accounting. So it's the role of financial accounting to capture information as things occur and then make that information available to management accounting. As a point of fact, in early ERP systems, financial accounting and management accounting were treated as two totally separate things, which made it possible for records to diverge and for there to be inconsistencies. Now, what you'll see in pretty much every enterprise information system is those two processes are brought together and the information is handled one time and shared between those two different contexts. Inventory and warehouse management, obviously if we're storing things, that's going to have a financial accounting implication related to the materials. And then project management, we're working through projects to produce things. There's going to be costs associated with that, materials and so on. So there's a lot of things that we will do. Really, you'd be hard-pressed to come up with anything that we would do that doesn't have some financial accounting dimension to it. Yes, sir?
I got a question. One of the questions is, are those circles on the outside different colors?
I think they are.
Well, and then my follow-up question to that would be why?
I think it's because someone tried to be artistic and like show the sun is somewhere over here on the right, and so some of those are getting more light and some are in the shadow.
So it has nothing to do with
Yeah, I don't think there's any kind of any color-related thing for you to be concerned with there. Someone just, I did not make this, I don't think I made this particular graphic, but if I did, it's because it was a standard PowerPoint graphic, and that's the way PowerPoint does it, to be all pretty. So, good question. Other questions? All right, so in financial accounting, there are really 5 different things that we tend to focus on, and I'm going to give you some more abbreviations to keep track of. The general ledger. We will talk a lot about the general ledger and how we use it, but the general ledger is what is going to keep the records that we will ultimately use to create our balance sheet and our profit and loss or income statement. So this is where transactional details get captured. And you notice down there at the bottom, the little diamond, FIGL. So financial accounting, when you see GL, just automatically associate that with the general ledger. You could make the case that that pretty much is the heart of financial accounting, is what goes on in our general ledger. FIAA, AA standing for asset accounting. These are transactions related to company assets. There tend to not be a great diversity of transactions. We mainly think of acquiring assets, depreciating assets, and retiring or selling assets. But still, it's a very important part of our overall financial accounting calculations, our asset accounting. FIBL, where BL stands for bank ledger. This is looking at our cash flows as an organization. In your lab work, you pretty much will find that you just have one bank account. I think it's called, I don't know if it's called bank account or cash. What is it? Bank account. You know, of course, that's somewhat simplistic. In a real organization, you may have multiple bank accounts. But nonetheless, one of the things that is of critical importance to an organization is managing its cash flow. And it's very important to realize, if you've ever taken an accounting class, you hopefully realize this. Hopefully your team figured this out when you were playing ERP Sim, although I still think a lot of teams never do figure this out. But your profit and how much cash you have on hand are two very different things. You could be profitable but be cash poor. You could be not profitable but have cash. It all depends on the different transactions your company has engaged in. The friend that I referred to just a few moments ago, one of his first jobs at Disney was to manage their cash flow. And in particular, one of the facets of his job was, for the most part, banking institutions shut down on Friday and then open back up on Monday. And an organization like Disney has potentially tens of, if not hundreds of millions of dollars in cash that they keep in their operating funds. You know, one of the things that I heard him talk about once is part of his job was watching all the money flow in from all of the different amusement parks every day. And that was under his purview, for all of that to be counted and deposited into the bank and so on. Well, if you have a bank account that has $175 million in it, you know, hopefully, if you have any banking experience, that you can put things in the bank and the bank will actually pay you money for holding on to your cash. They pay interest. Well, you know, you might put $10 in the bank and then at the end of the month see where you earned like 2.5 cents in interest. But if you put $175 million in the bank, the interest on that is going to not be a trivial number. And so one of the things he did on a weekly basis was figure out where they wanted to park their money over the weekend. And they would basically, at the end of the day, Friday, wire money out. And at the beginning of the day on Monday, they would bring the money back in and they would try and park it wherever they knew they could get the best return on it just over the weekend. Well, that's an example of the kinds of things a company might want to do in terms of managing their cash on hand. FIAR, accounts receivable. Accounts receivable, money coming in. So this is transactions related to our customers because we're going to be selling them things and then they're going to be paying for them over time. And so we capture that in accounts receivable. That's why I put there it has an SD or sales and distribution focus because this is tied to the fulfillment process. Whereas FIAP, accounts payable, this is now transactions related to our suppliers, to us buying things. So this would be related to both purchasing and materials management. So most of what we will talk about will fall into one of these four smaller diamonds here. And of course, all of that, the detail for that is going to be captured here in the general ledger and various other ledgers that have a relationship with the general ledger. Questions about this? Yes. Sales and distribution, or fulfillment would be synonymous with that. And I'm trying to, wherever I can, kind of give you the acronyms and abbreviations that are very commonly used by practitioners. All right, so let's talk about the general ledger. You had a homework question on your recent homework assignment that asked you to define the general ledger, and some of you gave a really, really good definition, and some of you gave a definition that was kind of not great. It would be kind of like if I asked you to define what a cat was, and you said, well, a cat has fur. Well, that's true, but that doesn't really tell me what a cat really is. What is a general ledger? A general ledger is an account-based record-keeping system that we use to keep track of all of our financial accounting transactions. So the general ledger, account-based record-keeping mechanism for financial accounting transactions. When you hear a company talk about their books, well, what they're really talking about is their general ledger, because of course if we trace this back through history far enough before computers, these were actually records that were kept in physical books for the sake of doing financial reporting. So our general ledger is this account-based record-keeping mechanism that we have for keeping track of our financial accounts. Well, account-based. Every general ledger is going to be structured per a chart of accounts. And a definition for a chart of accounts would be an orderly definition of all the accounts in the general ledger. So we have the general ledger, which is the actual record-keeping mechanism itself. And then the chart of accounts, if you will, I like to use analogies where they're appropriate. So I think this one works pretty well. A table of contents is to a book as the chart of accounts is to the general ledger. And by the way, I have no idea why. General ledger, 2 words, no slash anywhere in that term. But 9 times out of 10, when you see general ledger written, at least in the context of SAP, they put a slash between the G and the L. Don't know why, but I'll follow that convention a lot in the slides here. So every general ledger has a chart of accounts associated with it. That is just a definition of what the accounts are in the general ledger. So just like in a table of contents, if you wanted to know about a particular topic, you could look in the table of contents and it would say, oh, that's covered in chapter 5. Well, you go to a chart of accounts and say, I would like to know about asset, long-term assets. And it might say, oh, that's contained in this particular account. Account definitions. And this is a really, 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 really good question right here that might show up in the future. Account definitions in the chart of accounts consist of 3 things, 2 of which are fairly obvious, 1 of which may not be. The name of the account, the number of the account, and the account type. So the chart of accounts, just in looking at the chart of accounts, we can find out the name of the account, the number of the account, and the account type. So let's take a moment here and let's look at this. And we're going to look at a lot of things in our time together today, but this is a good place for us to start. So we're talking about financial accounting, so it should be of no surprise that we're drilling down into the accounting set of transactions here. Notice we've got a controlling section and enterprise controlling. That's suggestive that these would probably be things related to managerial accounting. We have very specialized groups here like real estate management. that could be very important to our organization, but really not anything we're going to do any work with this semester. But then underneath our accounting, sure enough, one of the things we see is financial accounting. And you'll notice, somewhat reflective of what we just talked about, accounts payable, accounts receivable, banks, fixed assets, special purpose ledger. This is kind of, once you start working with this system, hopefully you start developing a sense of where things might be found in the hierarchy. A lot of times you still have to go searching for things or use Google. But once you kind of get the hang of this, often you can just kind of drill down and find things on your own. So let's look at for a moment here things related to the general ledger. And notice we have document entry, master records, statistical key figures, periodic processing, corrections, a lot of different things there, but we're going to drill in, at least for the moment here, information systems, and look at some general ledger reports. And you'll notice here, financial statements, account balances, and so on. And where I want to go for the moment is general ledger reports / master data, chart of accounts. Okay, and what I'm just going to do here for the moment is do a search on this chart of accounts field to show you that in our system right now, there are 62 different charts of accounts that have been defined. Because what you get when you buy an ERP system is you get a sample chart of accounts for a given, typically, country, as you see it here. Chart of accounts for Hungary, India, Japan, Korea, Kazakhstan, North America, Poland, Peru, Slovakia. Then we can see all of the different chart of accounts that you guys have created. And then down here at the bottom, we see one that's very commonly used. INT is just a sample international chart of accounts. And so let's say, for example, we wanted to look at the international chart of accounts. Well, here is information on the accounts that would be available to us if we elected to use this as the chart of accounts for our company. And you notice that what you can see here is that every account has a name and has a number. What you're not seeing in this display at the moment is the type of the account. But this is one for INT. Just out of curiosity and because we can, let's pick another one here. Let's look at the chart of accounts for China. And there we go. So if you spoke Chinese, I'm assuming this would make some sense to you, but please do not ask me to read any of this to you because it's kind of interesting. Some of this is in English and some of this clearly is in Chinese. These are just typical charts of accounts that you might see for companies operating in these different regions of the world. So sometimes, if you have a brand new company and you're setting up a brand new chart of accounts and going to use SAP ERP, you might say, well, yeah, I'll just use one of these default chart of accounts and be done with it. The chart of accounts that we have been working with this semester, you actually got by copying them from a reference company code. And that is not at all unusual. What a lot of companies will do is they'll start with one of the standard sample ones, copy it over, and then delete things they don't need and add things they do need. So this is the chart of accounts for your organization that we're going to be working with this semester. Notice all of our account numbers are 6 digits. Starting at 100,000, you have the bank account. And we have a pretty good selection of accounts here, not all of which will we be using this semester. So this just tells us what the chart of account indicates for us is The name of the account, the number of the account, and the type of the account is not shown on the display we looked at a moment ago, but I think we can get there by drill down. We'll try that in a second. If not, we can go someplace else in the system. Now, when I say account type, what do I mean by that? Every account in the general ledger is designated as one of two things. It has to be designated, and it can only be one of these two things. It has to be either a profit and loss statement account or a balance sheet account. So everything on our general ledger is going to trace back to one of those two statements. It's going to trace back to showing its balances in the context of the balance sheet, or showing its balances and amounts in terms of our profit and loss statement. So general ledger accounts that relate to sales or expenses, those are going to be designated as profit and loss statement accounts. Accounts that deal with assets and liabilities and equity, those are going to be designated as balance sheet accounts. And I'll show you that more as we go along here. Let's go back to, for the moment, our system here and just see. And interesting. I don't know why that does. I think my ERP system semi-crashed there. No, I don't want to log off. But yes, I do want something more than just a totally blank screen. So I think I'm going to have to log off and log back in again. So give me a moment to do that. Hopefully you have not had too much trouble like this yourself, but I've noticed that when working with Wi-Fi and logging into the ERP system, sometimes if the Wi-Fi is a little bit flaky, you get bumped off like that if you have a period of non-activity. Let's go to another transaction where different than we went a moment ago, to look at some slightly different things. So I'm going to go into accounting, financial accounting, general ledger, master records, general ledger accounts, individual processing, and centrally. We kind of have to drill down into that a little bit. But this is one transaction that will let us actually look at different things related to our master records for our chart of accounts. Now, for some reason, I'm looking at this right now based on company code 20. I don't know who that is. We could come up here and change that if we were so inclined, and so I'll do that. I'll change it to my company code, which is 02, but in fact, you're not going to see much change here. So it just so happens that this pulled up account 300,000, which is my payables trade account. But you'll notice right here at the top, and some of this is grayed out at the moment, but you'll notice right here at the top, I have two radio buttons, P&L statement account or balance sheet account. Every account has to be designated as one of those two different things. So my payables trade account is a balance sheet related account. Let's go look for another account that would probably be something classified differently. And I will tell you this instruction is in your lab materials, but sometimes perhaps you might not have noticed it, and this will save you a lot of headache. By default, whenever you search your chart of accounts in your general ledger, it lists things in general ledger account order. And I have had some students that never did figure out that you could just click over here on this and it changes it to being sorted by account name in alphabetic order. So when I tell you, go and look for this particular account, you could just scan down things sequentially, or you could actually sort it in alphabetic order, which I think makes your life a whole lot easier. We probably have an account called, well, I was looking for revenue, but here I see sales revenue. Well, sales revenue, if we switch to that account, you'll notice that now this particular account is designated as a P&L statement account. So every account is going to be designated as a P&L account or a balance sheet account. And although we can see that in the general ledger, as a point of fact, where that is actually designated is in the chart of accounts definition. Questions about any of that so far? Okay, so as we just looked at, SAP ships with default charts of accounts for various countries and company structures. And so it is very, very common for a company to copy and then modify these as desired for use in their organization. So kind of the last statement I would make about this is the general ledger is the instantiation of the chart of account for a particular company code. And the last part is important to understand and can contain some or all chart of account accounts, which means that we might have an account that is defined in our chart of accounts, but because we copied this from some other reference source, we may not ever have a need for that particular account. And so it's listed in our chart of accounts, but we don't have any details on it. Or another way of saying that is we don't actually have a general ledger associated with that particular account because we've just never had cause to use it. Now, some of the accounts we are going to use on a daily basis a lot. Some accounts we might only use periodically for closing type activities. You know, literally some accounts may get used once a year for a set of transactions, and then they just sit unused the rest of time. So the frequency with which these are going to be used, or whether in fact they're really going to exist or not, depends upon our company and the way we account for things. So we said that accounts will either be balance sheet or profit and loss accounts. Yes, sir. Roger? Subsidiary. We're going to talk about that. We'll get to that. I think we'll get to that today here in just a few minutes because that's one of the key elements for us to make sure we nail down. Other questions? Okay, so this is a diagram from your book here. Balance sheet accounts. What would be examples of balance sheet accounts? Well, the balance sheet, first of all, if you've ever taken an accounting course, you know this right here. The equation, if you will, or formula that the balance sheet presents to us is assets equals liabilities plus equity. So I could actually take this and say this right here. Assets equals liability plus equity. And the way I like to think of that is an asset is something that we own, okay? Everything that we own is owned, if you will, in part by us and in part by other people. If you go and buy a home, the home might cost you $20,000. That would be quite the bargain. You might go buy a home and it would cost you $200,000. And you give the bank $10,000 and then you finance the rest. Well, when you move in, you own that home. In the eyes of the law, that is your home. So you have a $200,000 asset, but you don't actually own all of that home. You own what, 5% of the home? So if you will, 5% of the home is owned by you and 95% of it is owned by the bank. Everything a company has, either they own totally or they own in partnership, if you will, with some other entity. So that's this idea of everything I own, every asset is either represented by an equity stake, equity is what I own, and liabilities are what I owe to other people as it relates to this particular asset. So we could talk about different categories of assets. Liquid assets are cash or things that could be turned to cash very, very quickly. Receivables would be an example. Customers owe me money and every day they mail me checks and I process that. So that's cash coming in. Prepaid expenses, we won't get into the details of that. That's a kind of liquid asset as well. Materials, things related to inventory. I have raw materials, I have finished goods, I have semi-finished goods, I have trading goods. All those things you see sitting out in my warehouse or on my store floor, those are assets that I likely own. Fixed assets tend to be things that are permanent in nature. So this would be things like land and building and so on. So any account that relates to any kind of asset would be designated as a balance sheet account. Liabilities represent my obligation or my debt to third parties. So I take out a loan, that's going to be represented in terms of a liability account. I buy something on credit and I'm given 30 days to pay. Well, that's a short-term payable, but that's still a liability until such a time as I actually effect payment for that. So my liability accounts are all balance sheet accounts. Equity, once again, this is my ownership stake. And so we're going to see this reflected in accounts such as retained earnings and shareholder equity and things of that sort. So these are all things that are balance sheet accounts when we are looking at them in terms of what they're classified for in the chart of accounts and how we use them in processing our transactions. The second category we said was profit and loss accounts. So whereas the equation that drives the balance sheet is assets equal liabilities plus equity, profit and loss accounts relate to this question or this equation that our income is equal to our revenue minus our expenses. So any account that I use to capture sales revenue is going to be a profit and loss account. And any expense related accounts, my costs of goods sold, my payroll expenses, my water bill, my gas bill, my electric bill, my taxes, money that I'm paying out for bills would be classified as an expense account. So when you get right down to it, even though there may be hundreds of accounts in my chart of accounts, they're all either going to map to the balance sheet or they're going to map to the profit and loss / income statement. And so this designation helps us keep track of what's actually going to appear where. Questions about this? For those of you that have taken an accounting class before, this may be very, very simple stuff. For those of you that haven't, this represents a set of slides that you definitely want to study to be able to answer a question about, okay, what kind of account would a payroll account be? For you to be able to say, well, that would be a profit and loss account. So let's go back to talking about the chart of accounts for a moment. Every company code has to have one chart of accounts that they designate as their operative or operating. You either see those two words kind of used simultaneously, chart of accounts. So every company code has to have one of these. Now, this represents, if you will, their primary or their default chart of accounts. But the official term, and the one that you should be prepared to use, is we talk about this as being our operative chart of accounts. And we have to have one of those. Why does every company code have to have an operative chart of accounts? Yeah, if we don't have this, we can't do financial accounting. If we can't do financial accounting, we can't run our business. If we can't run our business, we're not really a company code at that point. So just like we observed before, that a client has to have a company code in it to be live, a company code has to have defined a chart of accounts for it to be a live and valid company code. Now, what's important to realize here is the same chart of accounts may be used by multiple company codes. Now, that is in fact what we have done for the sake of our labs, but I want to talk more about why this would be useful in business. So the idea was this semester, at the beginning of the semester, there was a reference chart of accounts out there, GL00. And what you did in phase 1 of your labs is you copied that to your general ledger, and in the copying process, you gave it a name reflective of your company code. So you created GL02 or GL15 or GL22 or whatever have you. So we could have one chart of accounts that is shared by multiple organizations. Now, what is very important to understand is, and I'm going to draw a picture that's slightly different than what's on the projector here, but fundamentally the same idea. We could actually have chart of accounts GL00. And whereas you copied yours and gave it different numbers, we could have company code 1, company code 2, and company code 3 that all use that exact same chart of accounts. So my question to you is, in my picture that I have drawn here, I will spot you the fact that there is one chart of accounts. How many general ledgers are represented? What's that?
Three.
There's really two good choices. I guess there's three choices. You could go with 1, 3, or 4. But in fact, the correct answer is there are 3 general ledgers here. Every company code has to have its own distinct general ledger. But we're all sharing the same chart of accounts. So what does that mean? That means that if we go into company code 3, into their general ledger, and look at account 100,000, we're going to see that that's their bank account. And that same number, and that same name, and that same account type is used across all 3 of these company codes. That is incredibly useful. Why would an organization want to do something like this? Okay, we might have multiple companies in our enterprise, right? We've observed that's the point of a client. Well, if you have 15 companies that are all related to one another, and you could use the same chart of accounts for each of them, that is going to make accounting record keeping much, much easier. So you will see that it is very, very common for multiple related organizations to use the exact same chart of accounts. Now, what you'll also see, well, I'll come to that in a second. Let's just go to this next point. The chart of accounts, we said that there are account types, where the 2 account types are balance sheet or profit and loss. There are also account groups. Account groups are different than account types. Account groups allows us to go into our chart of accounts and create clusters of related accounts. So the chart of account segregates accounts into different account groups. And as part of showing you this, I want to look at some of the lab work you did this semester. And this is all the way back in phase 1, where you were working with financial accounting. And you'll notice that here in 1-7, you went through and you defined field status variance. But as part of setting up the process for defining field status variance, you created different account groups: ZEXP, ZGBS, ZMMA, ZRAA, and ZREV. And you gave all of these groups names. All of these accounts that are in this group are all expense accounts. And all the ones that are in this group are general balance sheet accounts. And all the ones in this group relate to material management's goods receipt, invoice receipt accounts, and ZRAA for reconciliation accounts, and ZREV for revenue accounts. So you set up those account groups, and then as you continued working, you took one transaction, and I don't recall exactly what number it is, but you assigned different groups to different balance sheet accounts. Oh, it's this right here. In exercise 2-2.1, you went in and said, okay, I want the balance sheet accounts. Those are actually the accounts in my chart of accounts that begin 100000 and end at 399999. So the order in which these accounts are listed in the chart of accounts is not arbitrary. It's designed to allow you to clump things together. So for example, you'll notice that we have a range of accounts here that are all fixed asset accounts. And then we have a range of accounts that are liquid assets. And then we have a range of accounts that are material accounts. The nice thing here is that if you were an accountant and worked with this all day, as soon as someone started giving you an account number, in your mind you'd know what kind of account it was. But beyond that, this allows us to say, okay, with these accounts, there's certain things that we want to keep track of and certain things that we don't want to keep track of. Imagine, if you will, a typical SAP transaction screen. And there are all these different fields there. Have you noticed, just from your use of SAP, that sometimes there are fields that you have to put values in, and sometimes there are fields that you could put a value in or you could leave it blank? Well, that gets into what are called field status variants. What we can do is we can take accounts and we can segregate those into number ranges, put them in the same account groups, and then designate field status variants based on account groups. So note the progression here, and I'll tell you more about what a field status variant is in a moment. We have our chart of accounts, which we can break up into various account groups, and then for those account groups, we can set up these field status variants. This saves us a lot of time. This keeps us from having to go account by account by account and set these things up. We put all of our accounts into these groupings, and then we go in and we say, okay, for this group, this is the way I want this to work. And for this group, this is the way I want this to work, and so on. Now, I've got to find where this was in your lab account here, or in your lab work, and I think we did it here. And so I'm going to do a search here for field status variant. Define field status variants, page 12. All right, that's where we started. I'm looking for a picture. So I'm going to scroll really, really fast here. Ah. These pictures right here that you configured that you might not have paid much attention to the first time. These are the definition of field status variants. You will notice that what this is listing for us is basically a set of different things that this account can keep track of. So for example, we might say, okay, and this one is balance sheet accounts. For balance sheet accounts, one of the things that I could keep track of is the currency. Currency here meaning, is this US dollars? Is it francs? Is it euros? Is it some other currency? I have 4 choices here. Suppress means the user cannot even put that in. It does not show up on the screen. The assertion there would be maybe everything we do is in the same currency. So when the screen is displayed to the user, currency would be deleted off of the display. It would be suppressed. If I designate something as required entry. That means that not only is that field displayed to the user, they have to put a value in it. Optional entry, pretty straightforward. I put the information out there, I put the field out there, they can put something in it or they cannot. So notice what this is saying is that for all of your balance sheet accounts, when transactions go into the general ledger, designating a currency is optional, meaning that if another currency is not designated, we're going to assume it's US dollars. So I have four choices. I have suppress, required entry, optional entry, or display. Display would be the equivalent of read only. I show it to the user, but they can't change it or edit it in any way. So what field status variants do is they allow me to take into account all of the different things that the system could keep track of for the accounts in my general ledger, and they allow me to decide what should be here in the display and what shouldn't. For example, for balance sheet accounts, we don't have a reconciliation account. A reconciliation account for a balance sheet account doesn't make sense in the context of our organization, so we suppress that display. Let's look at some other things here. We suppress the administrator field so that that doesn't show up. We suppress, field status group required entry when we're actually creating an account. So the idea here, and I'll go back to my PowerPoint slides here. So we have a chart of accounts. The chart of accounts lets us segregate accounts into these different account groups. With these account groups, we can do things like assign to those account groups different field status variants. And the field status variants will tell us which fields in the records that are maintained for the accounts in those account groups, which records, which fields are suppressed, which are required, which are displayed, and which are optional. Now I showed you the screenshots of that from your lab work, so for the sake of time we won't actually walk through it together, but that's the significance of what you did back in phase one. And if you have questions about this, you might just want to go back and read through that again and kind of review the work that you did. Questions about this? Okay, this is a good place for one of our little test your understanding sections. True or false? Country-specific variations would be associated with financial accounting. True or false? True. Different countries, different laws. This points out the fact, however, that managerial accounting could be standardized globally. We can do what we want with that, so the fact that it's one country versus another is not really a decision point there. SD transactions are associated with general ledger, bank ledger, asset accounting, accounts receivable, or accounts payable. Which one is this? Accounts receivable. Sales, SD stands for sales and distribution. Selling things are almost always going to be done on account, which means the customer has time to pay us, which means we're going to be capturing that in the context of accounts receivable. This one should look familiar if you were paying attention. Table of contents is to book, as chart of accounts is to, what's this one? General ledger. General ledger. Which of the following is not a type of option for a field when setting field status variants? Required, optional, dependent, suppress, or read only. Dependent doesn't belong. There's another choice there that's kind of tricky. What's the other tricky one? Yeah, read only is not really called read only, it's called display. But the one that definitely doesn't belong there is dependent. There is no such field status variant. Okay, questions? Yes, sir.
About the lab work that we do, what sorts of questions will come out of there and kind of feature on our maybe
Mainly the things that you're going to be asked questions about will represent the things that we talk about in class, or the places where what we talk about in class intersects with your lab work, like what we just did. I don't know that you will see any question that solely comes from the lab work that you have done. But by the end of the semester, you should find that everything you did in your lab work, in one way or the other, we've talked about. For example, by the time we finish this discussion, most of, if not all of, what you did in phase 1 should be pretty clear to you. Okay. Good question. Other questions? Okay, so let's talk a little bit more about the general ledger. All, and I cannot emphasize that enough, all accounting relevant transactions are recorded in the general ledger. I think it was actually in another class where I was talking about this, but remember that we think of an enterprise information system, at least in part, like a huge vacuum cleaner that sucks up all of the transactional information of our company. Well, anything that we do that is accounting relevant has to be recorded in our company's general ledger. Now, if you think about that for a moment, you realize that the general ledger could become very, very, very populated, if not overpopulated, with transactions. So the general ledger, if you will, has a helper that are in the form of what are called subsidiary ledgers. Most of the time, you'll hear these referred to as subledgers, but subledgers is just a shortened form of the more formal term, which is subsidiary ledgers. Understanding the relationship between the subsidiary ledgers and the general ledgers is a key element that you want to make sure that you understand moving forward. The first thing to note is subsidiary ledgers and general ledgers work together extremely closely, but subledgers are not a part of the general ledger. They are independent of the general ledger, but they work in tandem in many transactions. So what are these subsidiary or subledgers? Subledgers exist for those entities that we tend to have a lot of transactions with. So we will have a subledger for all of our customer accounts. We will have a subledger for all of our vendor accounts. And typically, we will have an asset subledger in most organizations. And there may be other subledgers we would have. But the idea here is to keep track of all of our customers in one general ledger account would make record keeping a lot more challenging. It's similar to in an organization that had thousands and thousands of employees. When it came time to do payroll, to record individual checks being written to individual people in terms of individual general ledger postings would be kind of a nightmare. So instead what happens is the details are recorded in the subledger, and then a summarizing transaction gets reflected back to the general ledger. So we'll flesh that out a little bit more, but subledgers exist for certain things like customer accounts, vendor accounts, and asset accounts. Subledgers, and this is of critical importance, subledgers connect back to the general ledger by way of reconciliation accounts. So let me draw a picture and then explain what I'm talking about here. I have a lot of vendor accounts. Vendor accounts, that's companies that I buy things from, okay? So I buy things from Acme, I buy things from Stuff and Stuff, I buy things from Company X. You know, I have a lot of different companies that I buy stuff from. What's the most important fact for me to keep track of in regards to the fact that I buy stuff from these companies? Yeah, my accounts payable, how much I owe them, okay? Every one of these companies, when I buy stuff from them, they expect me to pay them back. So at any given point in time, I might owe Acme $500, and I might owe Stuff and Stuff $1,200, and I might owe Company X $5,000. Understand, of course, that in a company of some size, I could have hundreds of vendor accounts. I would not want all of the details of all these vendor accounts going into my general ledger. So instead what I do is all of this is captured in a subledger. All of this falls into the category of money that I owe these other companies. Well, in my general ledger, there will be an account with a number that I do not remember offhand for our chart of accounts, and this will be called accounts payable. And that general ledger account is connected to this subledger, so that anytime I change anything in this subledger, that change is reflected here in the general ledger account. But I can look in the general ledger account, and based on the facts here on the whiteboard, I can see that my total accounts payable right now is $6,700. But that's all I see in the general ledger. I see summary level transactions that let me know my total accounts payable is $6,700. If you want to know the details of who I owe that to and the particulars of transactions, that's going to be captured in the subledger. So that same principle will hold true. This is companies that I owe money to them. I'm going to have the exact same concept, but for people that owe me money, in which case this is going to be accounts receivable, and it's going to be tied to its own subledger. So the details are found in the subledger. The subledger connects up to an account in the general ledger. And this account in the general ledger that has this property associated with it, this is called a reconciliation account. So any account in my general ledger that has a corresponding subledger is called a reconciliation account. Reconciliation accounts have one very important facet. I cannot post to a reconciliation account directly. Here's an example, okay? Just follow my things that I have here on the whiteboard, and I'm going to erase some stuff here to give myself some room. Suppose I went into my general ledger and said, oh, I just did a new transaction. My accounts payable now is $7,500. What problem did I just create? Yeah, who do I owe it to? If I go into accounts payable and update this, my subledger tells me who I owe money to and how much. If I monkey with that number, I create problems. So the system won't let me do that. The system says, hang on, you can't change this balance. Now, if you incurred a new obligation, you could go down here and say, oh, I bought more stuff from Stuff and Stuff, and so now I owe them $2,000, and that in turn changes this balance to $7,500. That's fine. But when I take an account in my general ledger and I designate it as a reconciliation account, and I tie it to a subledger, at that point, I can no longer post directly to this account. The only way that transactions get into that account is by way of posts that are made to the subledger. And anything that gets posted to the subledger automatically gets posted to the corresponding reconciliation account. The reconciliation account in the general ledger is designated when the subledger account is created. So when I go in and I create a subledger, I will map it to a particular reconciliation account. And by the way, this is an area where some of you have had problems in your labs, because it is actually possible, if you mess stuff up, to direct this to the wrong general ledger account. And this is where you've gone in and you've set up things in the category of what is called account determination. Account determination is a blanket term used to describe a situation where something happens and the system automatically does our accounting postings. But the system does the accounting postings based on your configuration. Let me show you real quick what I'm talking about, and then we may be out of time for today. I'm going to go into another facet of financial accounting here. Accounting, financial accounting, but this time I'm going to go into accounts payable. Accounts payable, master records, display. Okay, so this is now asking me, okay, you want to look at the master record associated with one of your vendors. And you'll notice it's defaulted in my company code. I could type in a vendor's number here if I knew what that was. And you notice it asks me different things. Well, for the sake of what we want to look at right now, we're really focused on accounting information. I don't know right off the top of my head a good vendor to choose, so I'll have the system help me by searching for them. Here's my vendors that I've set up. So I'm going to pick a good old Fun in the Sun seats. Fun in the Sun seats, when I engage in transactions with it, that will be captured in the subledger, and it will go back to reconciliation account 300,000. Well, that's kind of interesting. What's reconciliation account 300,000? Reconciliation account 300,000 is my payables dash trade accounts, accounts payable. So anytime I create a vendor, I tie it to a general ledger designated reconciliation account. Now, in what I put on the whiteboard here, we did a very simple example like you might do in accounting class where we had one accounts payable class or one accounts payable account. In fact, in a real organization, we might see accounts payable domestic, accounts payable international. We might see several different categories of accounts payable accounts. And so different vendor accounts might be mapped to different general ledger accounts. This is account determination. This is now, if I go out and sell something, or excuse me, this is a vendor. If I go out and buy something on credit, and I record that transaction is going to show up as a debt to Fun in the Sun in my subledger, and when I go and look at my general ledger, I'm going to see that debt reflected there also. We'll get more into the details of how that works when we get together later this week. Any quick questions before we head out? All right, have a great afternoon, everyone, and I'll see you on Thursday.